Today is the day. 5 years ago, almost to the week, you signed a 1.79% fix on a £240,000 mortgage over 25 years. £998 a month. Affordable, predictable, almost forgettable. Today, that fix ends. Tomorrow morning, the standing order on your account will move not £998, but £1,486. £488 more every month for the next 5 years on a debt you have already been paying down for 5. That is what coming off a 2021 fix looks like in May 2026. It is not a forecast. It is the standing order that lands in your account in 14 days unless you have already moved. I am Harry. What follows is the day-by-day sequence 1.8 million British homeowners are about to live through in the order it actually happens, with the real numbers from a real reset in May 2026. Day minus 180. The window opens. Most UK lenders allow you to lock a new rate up to 6 months before your current fix expires. A handful stretch the window to 12. The window has just opened on your file, and you do not know it yet. Nothing arrives in the post. No alert pings on your banking app. Your lender's pricing engine has simply added you to a list somewhere in their portal. A product transfer offer is being calculated against your loan-to-value, your payment history, your remaining term. The offer will not appear in physical form for another 90 days. The decision, however, started today. The 6-month window is the difference between a clean reset and 6 weeks of standard variable rate exposure. The clock is now running. Day minus 150. The household conversation. Your partner mentions over coffee that the fix ends in May. You both know this. You both have known it for 5 years. The conversation lasts 4 minutes. There is no plan, only an acknowledgement. The new rate, whatever it turns out to be, will land somewhere between £1,400 and £1,500 a month. The household income has not risen by £500 a month since 2021. The childcare bill has risen by £200. The energy direct debit has risen by £60. The conversation ends with a vague agreement to look at the budget. Nothing is decided. The reset is not yet real. It is still 5 months away on the kitchen calendar. Day minus 120. The mortgage broker you used in 2021 sends an email. The subject line reads, "Your fix ends soon." The body is generic, written for thousands of clients on the same calendar. It tells you that early planning matters more than rate chasing in 2026. It mentions the 1.8 million figure. It asks for a 15-minute call to scope your options. You skim it, you file it. You assume there is time. There is, and there is not. The market has been moving every week since March, when the swap curve repriced upward on Middle East energy concerns, and the lenders followed within 48 hours. Day minus 90. The letter arrives. It comes from your lender, not your broker, and it tells you in formal language that your fixed rate ends on the 30th of May 2026. Attached to the letter is a product transfer offer, valid for 90 days. The offer shows your new rate. If you do nothing, the number on the page is 5.70%. It is a 5-year fix at 60% loan to value. There is also a 5-year fix at 5.65% with a £999 product fee, a 2-year fix at 5.81%, and a tracker option at base rate plus 0.79%, which today reads 4.54% and moves with the next Bank of England decision. You read all 4 numbers twice, you file the letter, the deadline feels far away. It is not. Day minus 75. The Bank of England holds base rate at 3.75%. The decision is announced at midday. By the close of trading, 5-year swap rates have moved 8 basis points. By the next morning, 2 lenders have repriced their fixed range upward by 0.10%. The 5.70% offer in your drawer is now competitive against the new market. It was not competitive yesterday. Lenders move quickly when swap rates lift, and 2026 has been a year of repeated lifts. The Middle East conflict, running since the previous summer, continues to push energy prices and inflation expectations The bank's own statement uses the word forceful to describe the rate path it would take if inflation persists. The word makes the financial press. The household reads it on the BBC homepage at 7 a.m., day minus 60. The reality lands. You sit down with a broker and you do the maths properly for the first time. Your current monthly payment is £998. The product transfer offer takes you to £1,486. The cheapest open market remortgage your broker can find takes you to £1,461. The difference between the two routes is £25 a month or £1,500 across the 5-year term. The open market remortgage involves a new application, new affordability checks, automated or physical valuation, legal work, and a 4 to 8 week processing window. The product transfer is 1 to 5 working days. The product transfer requires no new income evidence. The product transfer cannot be declined on affordability. The two routes are not comparable on price alone. They are comparable on price, time, and risk together. You start to understand why £261 billion of UK mortgage volume in 2026 is forecast to move via product transfer against £77 billion via external remortgage. The path of least resistance has a price tag. Day minus 45. The ERC overhang surfaces. Your broker pulls your original 2021 mortgage offer and reads the small print aloud. The early repayment charge applies until and including the 31st of May 2026. Your fixed rate ends on the 30th of April 2026, according to the marketing label, and on the 30th of May 2026, according to the actual completion-anchored contract. There is a 30-day overhang on the calendar. If you complete a remortgage with a new lender on 15 May, the redemption fee is 2% of the outstanding balance, which on £204,000 is £4,080 if you wait until June, the fee is 0. The completion date matters more than the application date. The contract was anchored to the day you completed in 2021, not the day the marketing page said your fix ends. You note the dates. You set 2 calendar reminders. The £4,080 is now visible on the timeline as a wall, and the timeline runs around it. Day minus 30. The decision day arrives. The 90-day product transfer offer is now 60 days into its validity. The cheapest remortgage your broker can build, anchored to a 1 June completion to clear the ERC overhang, is 5.49% on a 5-year fix at 60% LTV with a £999 product fee. The product transfer with your existing lender is 5.70% with no fee. Over 5 years on a £204,000 balance, the remortgage saves roughly £43 a month and costs £999 up front. The break-even is month 23. After month 23, the remortgage saves real money. Before month 23, the product transfer is cheaper in cash terms. You check whether you might move home before then. You decide you will not. You instruct the remortgage. The decision takes 11 minutes. It will save the household around £1,580 net across the 5-year term, after fees. Day minus 21. The remortgage application is submitted, bank statements, payslips, photo ID, and automated valuation against the lender's database. Your house was valued at £340,000 in 2021. The automated valuation returns £371,000. Your loan-to-value has dropped from 71% to 55%. The 60% LTV bracket holds. The application moves to underwriting. You receive an email saying the lender's offer should arrive within 14 working days. The rate you locked is the rate you'd keep, even if the market moves against you between now and completion. The rate is also portable downward in some lenders' policies if the lender reprices below 5.49% before your completion date. The lender confirms by email that they do offer a downward switch on request. You make a calendar note to check rates weekly until completion. Day minus 14. The mortgage offer arrives. It is a 22-page document. The rate is 5.49%. The term is 20 years. The monthly payment is £1,402. The product fee of £999 has been added to the loan, which lifts the headline payment by £6 a month. The offer is valid for 6 months from issue. The solicitor on the lender's free legal panel is instructed automatically. The conveyancing is included. There is no valuation fee. There is no broker fee because the broker is paid by the lender on completion. The total upfront cost to you, in cash, leaving your account before completion, is £0. The completion date is set for the 2nd of June, 2026, 2 days clear of the ERC overhang. Day -7, the final week of the old standing order. The old payment of £998 has been leaving your account on the 1st of every month for 60 months. You watch it land, for the last time, at 1.79%. The household has been bracing for 6 months. The shock is on the calendar, not in the moment. The week passes the way any week passes. The streaming subscriptions have already been culled. The grocery bill has already been retuned. The household, ISA, has already been paused. The household has, in effect, already moved to the new payment level by trimming everywhere else. The actual standing order change, when it lands, will be invisible against the budget that has reshaped itself around it. Day 0. The fix ends. The lender's portal updates at midnight. Your account shows the rate as pending product transfer for a 33-day window during which the standing order will continue at the old amount, because completion is set for day plus 33.